Hello, ladies and gentlemen. This is Alex Reed with your Thursday Market Roundup. So, first, let's get to the big news that, as of this recording, just a few minutes ago, Jerome Powell had a press conference and kind of laid out the Fed's analysis of the current market conditions as well as their intended path moving forward. And basically, what he said is that, just like I said last week, interest rates are going to be higher for longer. To the Fed's estimation, inflation is too high, and basically they want to continue to crash the American economy until they lower interest rates. So this is basically what myself and a lot of other people have been saying is gonna happen. We're not heading towards the quantitative easing, ZERP, 0% interest rates anytime soon. I don't think we're doing it within 5 years, maybe even not with even the decade. Of course, that's really difficult to say that far ahead. Um, Now, what I wanted to talk about today is the effects that we're seeing in the economy from these higher interest rates. So if we look, you can see that actually, their municipal bonds have over the past 15 years, 10 years, have been horrible investments. I think they're paying out about 1.8%. Um, Now, however, they're at 4.5%. So, I mean, you're getting a significantly decent return by investing in your local city or town's municipal bonds. If you don't know, municipal bonds are they're used to pay for local projects. So that could be infrastructure development, parks, roads, what have you. So when they were low, obviously there's less investment flowing into uh, these bonds. When the interest rates were low on them, there's less money flowing into them. So they have less money available to use for these projects. I actually think this is actually pretty good. The American system is all about. It was designed by our founders to be a local type of distributed government. When local municipal governments are stronger and have more cash flow and are using that money to invest in projects for their citizens, that is American democracy at its finest. We're not designed for a giant federal government to just hand out block grants that get whittled away through corruption and largesse. We're designed for small local uh, town and city centric government and state and up to state level. So actually, I mean, I think this is a positive benefit of the higher interest rates. Let's keep on going. Now, this is pretty interesting. So this is from the great Kobisi letter. I talk about him a lot. As you can see, what he's laying out here is that basically the ratio of the Nasdaq to the U.S. Treasury's return is currently at a record 8.2 times. So basically, uh, this is the return of the Nasdaq, which is the tech listing market listings, and versus the return of Treasuries. The Nasdaq is 8.2 times higher than Treasuries. As you can see, in this chart right here, go down, right there. So this is like back here in 2001. This is where it was at the tech bubble. This is where it is now. Whew, look at that, way higher, 70% higher, in fact, than it was in 2001, and 5.5% higher. 5.5 times higher than it was at the peak of the 2008 financial crisis, and this is the largest gap ever. Now, why is this important? Well, because in a market, it's all about isolating and locating proper value, right? So this is not based on historical trends. There is something disconnected, disjointed of the current market, the way that things are being valued, the way that stocks are being valued, the way that no matter what happens, stocks just seem to go up. So a lot of people are looking at these numbers and they're thinking, well, there's this disjointment. This disjointment can't last. Like the price discovery is broken. A lot of them are blaming the free money from the past 10 years that it just inflated all these stock prices, led to a dislocations in the American economy. Um, you know, I don't know. I The thing is my perspective on this, and I'll explain more about this as we go through. But things that have the paradigms that we've existed under, that investors have existed under for the past 30, 40, 50, even 60 years, they're not holding up anymore. So the question eventually, if everything isn't, if one thing is like an anomaly, you have to think, okay, well, that's just an anomaly. But if all these signs are an anomaly, right? If interest rates and if bond prices and stocks are, moving in lockstep at the highest rate in history, if gold is moving in lockstep, if all these assets, crypto, like if if they're all moving in lockstep, not how they should move. Conservative assets should move in reverse to more riskier assets like stocks. That's the whole point of them. If the inflation is still rising, but employment is still unemployment is still falling, unemployment is still low. Well, eventually all these like anomalies, all these like things that aren't like lining up anymore, you have to wonder if we're just in a new paradigm, if we're in a new world. There's something changed fundamentally in our financial structure that's making these past historical examples just not relevant to our current time. So, and then here's that chart again. You can see. I mean, it's insane. And this is getting to what I was saying is, if you're in a 60-40 strategy with your investments, so 60% in stocks, 40% in bonds, and the idea behind that is that when stocks are high and going good, you get capture that return. And when they have a downturn, your 40% of assets allocated into bonds, well, that protects you from the worst of it, because typically, right, what happens is bonds go down in value when the economy is good, because people are feeling good, they have money to spend, they put it into higher risk, higher return investments like equities. When we hit a recession, however, what happens? People flow to more safe haven assets like government bonds, U.S. government bonds, which are about the safest you can get. That's the thought, at least. However, that hasn't really happened in the last couple years. So while stocks have as they've underperformed, right? Bonds have also been underperforming, and that's because interest rates. A lot of people think that's because interest rates have risen so much faster than they've ever risen before. I mean, the rate hikes from the start of 2022, I believe it's 15, but it's never happened that much that fast. So this is again, if bond basically the way that the bond market works is if the interest rate increases, the coupon rate increases, well, then the bond you own becomes less valuable, right? So if you have a bond at 2%, and now interest rates, the interest rate of the bond is at 5%, well, who the heck is going to buy your 2% bond, right? So, and think about that. So this has led to bond prices plummeting because that 2% is just not that valuable anymore. So the current value, right, what you have in your hand, the current in hand value of your bond is just plummeting, and normally that is when that happens, it's a sign of boom times, like it should be, because the economy should be doing good, so the government is raising bond rates to spur investment into bonds. And then when the recessions come, they lower the bond rates, which improve the value of your bond. So if you have a 3% bond, and then all of a sudden the government slashes it to 2% to spur growth, so it makes it less attractive, the bond investment less attractive. Well, now your 3% bond is worth a whole lot more, right? So that's the way the market works. It's not happening that way. So if you've been in a 60-40 portfolio for the past 2 years, um, it's not doing well. And this is another point to what I was saying earlier. It's just it's some I think something has fundamentally changed in the way that the markets work. I'm not sure what it is. I don't think anybody really knows what it is, but I think we can all feel it, that it's just not lining up. These traditional concepts that we held just aren't really working out in the real world. Um, and, you know, the 60/40 portfolio isn't the only sort of casualty of this higher for longer environment. And this is going to be really interesting to see how this continues to play out in the housing market because uh, this whole week there's just been headline after headline of talking about home sales and how the housing market is just cratering. Nobody's selling, nobody's buying, nobody can buy, nobody can afford to buy. Um, this headline in particular talks about the limited supply, right? Because if you had a 2% interest rate on your house, even if you don't want to live there anymore, you really don't want to sell it and then get a, what is it, 8% now mortgage rate on your new place. It just makes the economics not good. So people are just huddling down and they're not selling. Meanwhile, there's still people who want to buy houses. So not only are people not selling, but check this out. The mortgage rate, since it's 8%, is causing houses to just be exorbitantly expensive. This is from Ben Carlson, A Wealth of Common Sense. Definitely recommend you check out his blog. It's excellent. But you can see here, this is the most important part of this. I just want you to see the 10-year yield, 4.9%. The 30-year mortgage rate is 8%. 8%, that's huge. Now, check this out. This is really interesting. He did this math. So let's look at it. If a median existing home price is $413K, with 20% down and a 3% mortgage, you'd pay $171,000 in interest over the life of the loan. With 20% down and an 8% mortgage, you're going to pay $543,000 in interest over the life of the loan. So now that loan at the current mortgage rates costs more than the house. That's not a good deal. You shouldn't. I mean, I wouldn't do that. I wouldn't do that with my own money. So I don't know. I feel like something has to break in the housing market. Either we have to have a giant amount of supply come online, or people are going to we're going to have some serious foreclosures hitting, or at the very least, people are just going to be priced out, and I don't really know what can fix that. And it's gotten so bad that for the first time in a long time, it's actually cheaper to rent than buy. I mean, it's you not only do you not have to put the down payment down, but you don't have to worry about the extra maintenance costs of a home, all of the unforeseen liabilities that you incur with that. So of course rents are still going up, so this is driving rents up. So it's like no matter which way you slice it or dice it, if more people are renting, rents are going to go up because we still have a limited supply of apartment buildings in this country. So no matter where you turn, things are not looking good for living, for housing, apartments, single-family homes, or investment homes, investment properties. So this Nick Gurley is he's great. A little too doomer for me often, but this is a good chart. So basically, what is the cap rate in an investment property? If you're a real estate investor and you have like a multifamily unit, right? What's your cap rate? Well, your cap rate is basically the return on that investment property. It's just like what the same thing as like if you had like a 3% on a bond, right? So usually in investment properties, the cap rates hover recently. They've been hovering around 4 to 5%. That's typically what you'll find with investment properties. So, and of course, being a landlord, it's not risk-free. You have liabilities. You have to do maintenance. You have to do all this stuff. But why do that? Why go through all that? Why go through all of that when you could just buy a 10-year treasury? Because right now, the 10-year treasury, one of the safest assets in the world, maybe the safest, and it's paying out more than the typical cap rate on an investment property. Now, you could argue with an investment property, you do get leverage if you only, as like real estate, right? Real estate investors, they put a down payment down That's not the full value of the house, but they can get the cash flow based on that house's full rents rolls, that units, that property's full rents. So you do get leverage, and you can use those rents to pay off the mortgage, and then yada yada yada. And then through a 1081 exchange, you could roll that property tax free into a bigger property. So there's still benefits to doing in real estate investments over just a 10-year treasury. However, this is just crazy that you can just get a better return from dumping your money in a 10-year treasury. And with Powell saying that this is not going to end, who knows where these charts, all these numbers, where interest rates will finally end. In the meeting today, he didn't really indicate whether or not they're going to raise anymore, but we'll see. Unemployment, it just came out, and it was the new unemployment filings were way lower than expectations. And this goes, if you watched my video last week, I talked about how we have some secular trends driving high employment, namely boomers, who are the largest workforce in U.S. history, are all exiting the workforce. And there's just not enough people to fill them. So you can argue that we're not having a huge unemployment spike. However, we're not actually having a filled economy. The economic jobs that are there aren't being filled either. So we're in this sort of no man's land. And this gets to the unemployment figures, and this is a sort of a counter to the low unemployment. So initial claims are they've usually been revised up in the Biden administration, for obvious reasons. The numbers are released. They make them look good. And then, a few weeks later, when everybody's moved on, they revise. Oh, so actually, after compiling the full data, well, now they're a little higher than they were when we initially released the numbers. And WinSmart CFA on Twitter, they looked at they looked at jobless claims. They dug a little deeper into the data, and it's pretty interesting. So initial claims are one way to look at unemployment, but also you can look at continuing claims, right? People who are out of the workforce but haven't been able to find a job. And what's pretty interesting about that is because there's a certain amount of dynamism in every economy, right? People lose their jobs, but they can find another one here, right? You get laid off at this store, well, you get hired at this store. Continuing claims, though, can be an indicator that there's just no jobs available. Once you lose yours, you're just not going to get another one because they're not there. So this is what this chart represents. This is basically the number of U.S. states with a greater than 20% year-over-year increase in continuous claims. Now, if you notice, you can see a few little spikes on this chart. And what do we see? Well, we see the beginnings of in the beginning of the 1990s, we had a little recession. Obviously, the 2000s, beginning of the 2000s, you had the dot-com bust. This third gray line here, you have 08 and 09 financial crisis. 2020, obviously COVID. But now, but look how low the numbers were in between all those major events. Now look at how high and how quickly rising the number of continuing claims is. So based on this, well, the economy is softening, and I would say honestly, I do think the economy is softening. I think that we have one more interest rate increase in the tank from the Federal Reserve, and I think after that, I don't think they're going to lower them, but I don't think they're going to raise them either. And I think we're going to have a pretty soft, a softer economy. I do think there's reasons that I don't think we're going to hit a hard recession, but I do think it will be softer over the next year and a half. What's going to be really interesting is seeing what stops the Biden administration pulls out prior to the election to see if they can get their, if it's Biden or somebody else, over the finish line. That will be really interesting to see. what economic initiatives are done. But I do think that the next year and a half, I think we're gonna have to be smarter with our investments, more choosy. I don't think that the entire 60/40 portfolio is really going to be the best for the next year and a half. Obviously, those are just my thoughts. But anywho, that's the market wrap up for this Thursday. Um, Let me know how you like this. Feel free to shoot me an email or comment on the video, and I will talk to you next week. Alex out.